Every time price moves on your chart, something specific happened. Not random, not luck, not an algorithm deciding to push price in a direction for no reason. Something mechanical, something repeatable, something that follows the same logic every single time across every single market in the world. And once you understand that mechanics, you will never again look at a moving price and think it is mysterious. You will look at it and read it, like reading a language you finally learned after years of hearing it without understanding. This video is that lesson. The deep mechanics of how price actually moves, not the surface explanation, the real one. Video 6 of the Complete Trading series. Let's get into it. In video 1 of this series, we established that price moves because of aggression. Aggressive buyers lift the offer. Aggressive sellers hit the bid, and the side that is more aggressive moves price in their direction. That was the foundation. This video goes deeper, because aggression alone does not explain the full picture. It does not explain why price sometimes moves explosively and sometimes barely moves at all despite heavy volume. It does not explain why price reverses sharply from specific levels while breaking through others with no resistance. It does not explain the difference between a move that continues and a move that fails. For all of that, you need to understand the order book, what the order book actually is. The order book is the real engine of price movement. It is a live, continuously updating list of every resting order in the market at every price level. On one side of the order book are the buy orders. Resting limit orders placed by participants who want to buy at specific prices below the current market price. On the other side are the sell orders, resting limit orders placed by participants who want to sell at specific prices above the current market price. The current market price sits between these two sides. It is the price at which the most recent transaction occurred, and the next price will be determined by which order is hit next. Here is how a single price movement happens at the mechanical level. Imagine Bitcoin is trading at $50,000. There is a resting sell order at $50,010. A buyer decides they want to buy right now. They place a market order. Their market order immediately matches with the cheapest available sell order, which is the one at $50,010. The transaction happens. Bitcoin trades at $50,010. The price has moved up by $10. Not because sentiment changed, not because news broke, because one buyer placed a market order that consumed the resting sell order at that price. That is how every single price movement begins. One participant deciding to act aggressively and consuming a resting order on the opposite side. Now scale that up. If there are 1,000 resting sell orders at $50,010, one market buy order will consume one of them. Price stays at $50,010. Another market buy order comes in, consumes another. Price is still at $50,010. The buy orders are hitting the level, but not moving through it because there are too many sell orders resting there absorbing each hit. This is what absorption looks like at the mechanical level. A price level with enormous resting orders acts like a wall. Buyers can hit it repeatedly, but price cannot move through it until the wall has been consumed. Now imagine those 1,000 resting sell orders at $50,010 are suddenly gone, withdrawn by the participant who placed them, or consumed by a massive institutional buy order. Now the next available sell order is at $50,100. The next market buy order has nothing to match against until it reaches that level. Price jumps $90 in a single transaction. That jump is a fair value gap. The price skipped through levels where there were no resting orders. There was nothing to buy from between the two levels. This is why fair value gaps form. Not randomly, because order book liquidity disappeared at those levels, allowing price to jump through them without resistance. The bid-ask spread, the most fundamental price mechanic. Every price you see on your chart has two sides, the bid and the ask. The bid is the highest price a buyer is currently willing to pay. The ask is the lowest price a seller is currently willing to accept. The difference between them is the spread. When you place a market buy order, you buy at the ask price. When you place a market sell order, you sell at the bid price. The spread is the minimum cost of every single trade, and the spread tells you something important about the current liquidity of the market. A tight spread means the market is highly liquid. Many buyers and sellers are present close to the current price. Large orders can be filled without significant price impact. A wide spread means liquidity is thin. Few buyers and sellers are present near the current price. A single large order can move price significantly because there are few resting orders to absorb it. This is why markets move more aggressively during low liquidity periods. The Asian session in Forex, for example, has lower volume and wider spreads than the London or New York sessions. A single institutional order during the Asian session can move price much further than the same order placed during peak London hours, when millions of orders are resting near the current price and absorb each transaction with minimal price impact. The time of day changes how far price moves per unit of volume. Understanding this is the foundation of session-based trading. Market orders versus limit orders, the two forces that create all movement. Every price movement is the result of an interaction between two types of orders: market orders and limit orders. A market order is an aggressive order. It says, execute now at whatever price is available. It consumes liquidity. A limit order is a passive order. It says, execute only at this specific price or better. It provides liquidity. Market orders move price. Limit orders resist price movement. When aggressive market orders outweigh the passive limit orders at a specific price level, price breaks through that level. When passive limit orders are more than sufficient to absorb all incoming market orders, price stalls at that level. This mechanic explains every price behavior you will ever see on a chart. Strong trend moves happen when market orders are pouring into the market in one direction, overwhelming the limit orders on the other side. Price consolidation happens when market order flow slows to a level where the resting limit orders can absorb each incoming order without price moving significantly. Price reversals happen when a large cluster of limit orders absorbs the incoming market orders until they are exhausted, and then the market order flow switches direction. Everything is market orders versus limit orders, aggression versus patience. Every candle on your chart is a record of how that battle resolved during that time period. Why price moves faster through some levels than others. This is one of the most practically useful insights in this entire video. Price does not move at the same speed through every price level. Some levels it moves through instantly with large candles and no hesitation. Other levels it moves through slowly, with small candles and frequent reversals. The difference is the density of resting orders at each level. Price moves fast through levels where very few resting orders exist. There is nothing to absorb the incoming market orders. Each order moves price to the next available resting order, which may be far away. Price moves slowly through levels where many resting orders exist. Each incoming market order is absorbed by a resting order without moving price further. The market order flow has to overwhelm the entire cluster of resting orders before price can move through. This is exactly what volume profile measures. It is the accumulated record of how many transactions occurred at each price level over a given period. High volume nodes on the volume profile are price levels where enormous numbers of transactions occurred. This means enormous numbers of resting orders were present at those levels. When price returns to a high volume node, it will encounter the same type of resistance it encountered before. The buyers or sellers who provided liquidity at that level previously will likely provide it again. Low volume nodes on the volume profile are price levels where almost no transactions occurred. This means almost no resting orders were present. When price enters a low volume node, it will move quickly because there is almost nothing to absorb it. The mechanics of a liquidity sweep. Now let's bring everything together to explain the most important mechanical event in smart money trading: the liquidity sweep. A significant swing low forms on your chart. Below that swing low, thousands of retail stop losses are resting. Those stop losses are sell orders waiting to trigger. They are a massive cluster of market sell orders sitting just below an obvious price level. An institution needs to buy a large position. To buy a large position, it needs an equally large amount of sell orders to match against. The resting stop losses below the swing low are exactly the source of sell orders it needs. The institution engineers a push below the swing low. Price breaks the level, triggering all the stop losses simultaneously. A massive wave of market sell orders floods the market. The institution absorbs every single one of them, matching each sell order with its own buy order. Price quickly recovers above the swept level because the institution has now consumed all the available selling. The buyers who placed their stops at that level are out. The institution is in, and with the selling exhausted and the institution fully positioned, price begins to move in the institution's intended direction. This sequence happens not because institutions are manipulating the market in an illegal sense. It happens because institutions need large amounts of opposing order flow to fill their own positions. And the most efficient source of large opposing order flow is the predictable clusters of retail stop losses sitting at obvious technical levels. The sweep is a mechanical solution to the institutional size problem that Video 3 described, and understanding it at this level of detail changes how you see every significant wick on your chart. It is not random. It is a transaction. A specific type of transaction where one side needed the other side's orders badly enough to engineer the conditions that would release them. Why support and resistance levels work, and why they stop working. Every significant support level is simply a price level where a large number of resting buy orders exist, either placed directly as limit buy orders by participants who want to buy at that price, or indirectly as stop losses from short sellers who will be forced to buy to cover if price rises to that level. When price falls to that level, the incoming sell orders are absorbed by all those resting buy orders. Price stops falling and reverses. That is support. Simple, mechanical, but support levels stop working when those resting buy orders get consumed. Each time price visits a support level, some of the resting buy orders at that level are matched with incoming sell orders and consumed. After 2 or 3 visits, the cluster of resting orders is significantly smaller than it was after the first visit. After enough visits, there are almost no resting orders left at that level. The next time price reaches it, the incoming sell orders find almost no matching buy orders. Price falls straight through. The support level has been consumed. This is why old support levels that have been tested many times eventually break. Not because the technical analysis failed, because the mechanical reality of repeated visits consumed the order flow that was holding the level. Reading price movement in real time. Now let's put all of this together into a practical framework for reading price movement as it happens. Every time you see price moving on your chart, you are watching market orders consuming resting orders. When price moves quickly with large candles, the resting orders at those levels are thin. Price is moving through a low-density area of the order book. When price moves slowly with small candles and frequent reversals, the resting orders are dense. Price is being absorbed at a high-density area. When price makes a sharp move and immediately reverses, a large cluster of resting orders absorbed all the incoming market orders, and the market order flow was not strong enough to break through. When price breaks through a level that held many times before, the resting orders at that level have finally been consumed by repeated visits, or a single aggressive order was large enough to consume them all at once. Every behavior you see on a chart has a mechanical explanation rooted in order flow. The candle shapes you learned in Video 4 are the visual expression of this mechanics. The time frame framework you learned in Video 5 tells you which level of this mechanics you are looking at. And the concepts that come later in this series, market structure, liquidity zones, order blocks, volume analysis, are all tools for reading the order book mechanics without needing to see the actual order book. You are learning to read the fingerprints of order flow rather than the order flow itself. And that skill, developed consistently over time, is what separates traders who understand markets from traders who are still guessing. Here is the mindset shift from this video. Price is not a line on a chart. Price is the current state of a continuous battle between market orders and limit orders. Every candle is a battle report. Every wick is a failed attack. Every breakout is an overwhelmed defense. Every reversal is a successful defense. When you see price this way, the chart stops being a mystery and starts being a record of decisions made by participants with different sizes, different intentions, and different information. Your job is to read that record accurately enough to know which side currently has the advantage and position yourself accordingly before the crowd sees what you already read. Drop a comment. Which part of this video changed how you see price movement the most? The order book mechanics, the bid-ask spread, or the liquidity sweep explanation? I read every single one. See you in the next video. Stay disciplined.